We'll let people join for a minute and then get started. All right, I see people filling in now. I'll give it another minute or so. All right, I'm sure people will continue joining over the first few minutes, but we can go ahead and get started. So good afternoon, everyone, and welcome to our quarterly webinar where we will discuss our Q1 2024 financial market and portfolio update. We'd like to thank everyone for taking the time to join us this afternoon. I'm pleased to introduce you to our Chief Investment Officer, Steve Galli, who will share his insights, and we encourage your participation. So if you have any questions, don't hesitate to put them in the Q&A or the chat. And we are excited to learn from Steve as always. I know there's a lot to cover, so without further ado, let's dive in to the Q1 2024 financial market update. And I'd like to pass it over to Steve to take it away.
Thank you, as always, Katie, and thank you all for joining on this fine February day. This is the post-Valentine's Day special portfolio update. I hope everyone had a nice Valentine's Day. So let's get into it. Lots to talk about, lots going on in the markets. So as usual, we'll discuss kind of some of the things happening out there, look over some of the latest headlines, and then we'll get into what we think that means in terms of what to do in regards to portfolios and our investment strategy. And at the end, of course, we'll always have time for some Q&A. And you can also enter some Q&A in the chat as we're rolling here. So here's the latest headline from Barron's. This was only a few days ago on the weekend edition, where, the S&P recently hit an all-time high. We are at all-time highs in the market. And so, the question is that a bad thing? Is that a good thing? Or should we be excited and euphoric, or should we be scared? So we'll talk more about that. There are some issues out there, some hiccups, I would say, especially in the China region. There's a lot of pressure on the real estate sector in China. That's we're seeing that bubble sort of start to pop and deflate, and that could have some ripple effects, although fortunately somewhat contained so far, just relative to China. I thought this was a really interesting article. Another China hot topic is how, the China's one-child policy that was instituted, many, many years ago has really impacted their demographics. And so, that's having some unintended consequences, to say the least, on their economy and future earnings potential for their economy. So, that's another headwind, I would say, to China's growth, which will also have ripple effects globally. Here's another one from the Wall Street Journal, directly saying stocks are at record highs. Are they expensive? And depending on how you look at it, some people say yes, some people say no. And then last but not least, we'd be remiss if we didn't show an artificial intelligence headline. Everyone's talking about artificial intelligence. That's all the rage. That's why tech stocks have been on such a tear. And, I think we've talked about artificial intelligence before, and the fact that, there's probably going to be some jobs that are impacted by AI, right? Because if anyone's heard me talk about AI before, there was a famous scientist many, many years ago by the names of Hans Moravec. And Hans Moravec developed what was called the Moravec paradox, which had to do with artificial intelligence. And this is before AI, what it is today. He was looking at this, several decades ago. But the paradox, and I think this is pretty interesting, is that AI is really, really good at doing things that we humans find really difficult to do. Like, for example, doing a differential math equation in my head. I can't do that, but AI can do it, in a nanosecond. But the paradox is that AI is actually really, really bad at doing things that we humans find relatively simple. which would be, let's say, buttoning the top button on my shirt here, right? So, so the point is, that's why if any jobs are really going to be threatened by AI, it's going to be more of those higher end intellectual white collar jobs versus, jobs that aren't relating to a lot of that higher order brain functionality. So, we'll see how that plays out, but we'll talk more about AI in a little bit. So, it wasn't too long ago that everyone was talking about how we were going to have a recession. I really don't hear people talking about that. That makes me a little nervous, right? So, and I think there's a couple of camps. A lot of research is saying our economy is doing really well. Our GDP numbers are strong. We don't have to worry about a recession. Another camp, and this is kind of one of the other camps, is that yeah, but the U.S. consumer is running out of steam. And so, in this headline here, is the U.S. consumer going to be the last domino to fall before we start to see some trouble in our economy? And so I think this is an interesting chart, because the point of this chart is that basically, except for the households that have really high income, so we'll call them the top 20%, they still have a lot of spending power. They still have a lot of excess savings and deposits. But for everyone else, they don't. They're starting to dip into their savings. They're starting to really feel the pinch of higher prices, which, prices are high, right? We had pretty rampant inflation last year, and that resulted in, higher prices. And those higher prices aren't going away. Now, yes, inflation has come down, but all that means is that prices aren't rising as fast anymore. The prices that have already come up, they're going to stay up. And that's starting to really impact the consumer. So the question is, will this really start to impact the economy moving forward, which could be a recession starter, so to speak? So, and why do we talk about the consumer as being important? Well, that's because over 2/3 of our economy is dependent on consumption. And consumption is driven by the consumer. So, you can see in this on the bars on the right over here, that is why we care about what happens to the consumer, whether they're spending or not, whether they have enough savings, are they pulling back? That's what drives a lot of our economic growth. And you can see by this chart that last year, quarter over quarter, we were pretty strong. As a matter of fact, fourth quarter GDP growth was 3.3%, right? Well above the long-term average of 2% growth. Right. So that's why people are feeling pretty good about the economy. Why should we have to worry about anything if we've got such great GDP growth? But, I think if we dig into some of the details here on the argument, I think this is a reasonable argument to make, which is, things have been pretty good. We've had really benevolent financial conditions. We've had rising home prices. We've had good reasons that growth has been there. We've had legislation that's encouraged corporations to invest. We've had the CHIPS Act, the Infrastructure Bill. We've had the Inflation Reduction Act. And, that all that stimulus is starting to come to an end and going to wear off. And if that does start to wear off, that's when you're going to see probably more of an impact to employment. Now, we always talk about employment, because employment is that one indicator that once unemployment starts to go up, it tends not to stop. It tends to keep on going. And that's when you see a recession, right? So we still have unemployment bouncing around near its lows, but wage growth is slowing. Job growth is slowing. There are indicators, leading indicators on employment, that tell us that we don't think that unemployment is going to stay near record lows much longer, right? And if that happens, well, then consumers will have even less spending power because they'll be out of jobs, right? And that's when you're going to see maybe some potential issues in our economy. When that happens, hard to know. Possibly later this year, possibly next year. And of course, some people think it won't happen at all. So, but that's when I think, that's when I get most nervous, is that when people aren't talking about a recession, that's actually when they tend to happen. The analogy, on bullet point 2 here is, that's when you get the flu, right? You get the flu when you're feeling good. You don't know you've got the flu until you actually start seeing the symptoms. So that's kind of the way recessions work. Before you know it, we'll be in a recession when no one was talking about it. So, we want to be a little bit cautious with that in mind, but there's also the camp of why we don't have to worry too much, and we'll get into that a bit. And so, when we talk about the economy, we also have to talk about, well, what's the market doing, right? And so this actually is a snapshot of the valuations, and this looks at the way to value markets in different ways. You can use the forward price to earnings ratio. You can use a smoothed out price to earnings ratio, which is known as the CAPE, or the cyclically adjusted price to earnings ratio. You can look at dividend yields. Are they historically low or high? You can look at price to book value, price to cash flows. Any way you slice it, a year ago, things were a little expensive, right? The long-term average of the price to earnings ratio of the market is around 17 times. In other words, you got to pay 17 times for every dollar that you buy for a stock. And that last year was around 18. Above average, but not nosebleed expensive. But here we are today. This is basically a week ago. And now we are starting to get into that, rarefied air of, anything within these two lines, anything in this zone is, that's where the valuation of the market tends to be about 2/3 of the time, or better known as one standard deviation. Once you get past these dotted lines, which is where we are getting to right now, that's when the valuations are stretched, right? And so the bottom line is valuations are starting to get stretched. The market's expensive. If I want to buy a stock, I'm paying $20 for every single dollar of earnings that I'm buying, right? That's expensive. So that can change, though, in a few different ways, right? Now, the obvious change is that stock prices can come down. That would lower the PE ratio. But the other way it can change is that earnings can go up, right? And if earnings go up, that'll also lower that PE ratio. And actually, that has been happening. So about a large majority of companies have reported their fourth quarter earnings, and as you might have been seeing the headlines as companies have been reporting earnings lately. And interestingly enough, about 80% of those companies have beaten their earnings forecasts. So all these super smart Wall Street analysts spend all this time dissecting companies and trying to predict what their earnings are going to be. And those are known as earnings estimates. So the fact that 80% of companies have beat their estimates is a good thing. And you might ask, well, why is that a good thing? Well, that's because on average, companies tend to always beat their earnings estimates, but they beat them about 63 to 65% of the time. So 80% of the time is way better than the average earnings beat. And that's what's been happening. So, that's been pretty supportive of the market. So I think this is an interesting start. We kind of borrow research from our friends at Goldman Sachs on this one. The point here is that the S&P took over 2 years to reach a new all-time high. The last all-time high we saw was over 2 years ago. And when that has happened, the point of this chart is that the S&P maintains its momentum during the next year, right? So generally speaking, on average, if it takes over 2 years for the S&P to hit an all-time high, which it did this time, it took over 2 years because we only hit an all-time high in early February. The next 12 months tend to be pretty good, relatively speaking, on average. That's what the statistics tell us. Now, are statistics always right? Of course not. But it's nice to know that there's reason to believe that perhaps the market will do pretty well over the next year. Another recent statistic, 75% of the time when the market is positive in January of any given year, it ends up being positive for the year. Well, were we positive in January this year? Yes, we were. The S&P was up a little over 2% in January. That means there's a 0.75% chance that, or I should say a 75% chance that the market will be positive this year. So, we can take those numbers with a grain of salt, but, it does give us some comfort that things maybe aren't too bad. There are some other reasons why I take comfort in where the market is now too, and I'll get to those in a minute. But before that, we have to talk about bonds. Everyone knows I love bonds. I used to be a bond trader. Bonds are great because they're safe. And 2 years ago, bonds weren't so great because if you were investing in short-term bonds, you really weren't earning anything. You were lucky to earn 0.5%. But 2 years ago, the yield curve was sloping in a normal direction, right? Meaning if I invest in a short-term bond, I don't get paid as much if I invest in a longer term bond. That's called an upward sloping yield curve, which is generally the way you would expect it to be, because if I'm going to take risk and invest in a longer term bond, well, I should be compensated for investing in a longer term bond and taking that risk. So I should be paid a higher interest rate. But of course, that is not happening today. Today, the yield curve is inverted. I'm not being compensated for taking risk by investing out here in the yield curve, right? So that's why a lot of people are investing in the short-term bonds, right? To take advantage of these higher yields at the short end. The problem is eventually this yield curve will normalize, right? And when it does, a lot of people were saying, well, when those short-term maturities mature, which will happen in less than a year, people will say, oh, now what do I do? Oh, I wish I could have invested in a 5-year bond that was yielding over 4% because maybe in a year, the 5-year bond will only be yielding 3.5%, right? So that's one of the reasons why we always want to make sure we have good exposure across various maturities, because it's hard to know where the yield curve is going to end up. But I think one of the reasons that I do have comfort that the stock market, even if we see a dip, and by the way, when I say dip, it is quite common for the market to drop 10% during the year, right? That happens actually quite often. A 10% drop actually might feel, kind of stomach wrenching for many of us, but that does happen quite often on an intra-year basis. If it does, I feel pretty comfortable that we're going to see a lot of cash flow into the market to take advantage of that dip. And why do I say that? Well, I say that because that yield curve is inverted. If people are somewhat cautious or staying on the sidelines, which many investors have been, people have been waiting. Last year people stayed on the sidelines waiting for a drop that never happened. But they feel pretty good about staying on the sidelines because they've been able to invest their short-term cash sitting on the sidelines in somewhat attractive yields, right? Because of that inverted curve, if you can earn 4 or 5% on your cash while you're sitting on the sidelines doesn't feel so bad. 2 years ago, if you sat on the sidelines, you were earning almost nothing with your cash. That didn't feel so good. But now if you're sitting on the sidelines, you actually are earning something. And so the point is, if we do see a drop in the market, there are a lot of people who are waiting for that drop. There is actually, I think, based on estimates right now, this is telling us that there are close to $6 trillion sitting in money market fund assets. That's, almost 2 trillion more that was sitting in money market fund assets, 2 years ago. That's a lot of money. That's a lot of buying power for stocks if we see a drop. So that's one of the reasons why I do take some comfort in the fact that even if we have a drop this year, I think that drop will have some mitigation based upon all this excess cash on the sidelines. So that's one thing to keep in mind. Now, anyone who's familiar with me talking about why I like bonds a lot is because the other reason is because interest rates, especially short-term rates, are at a higher point today, right? It's created a situation where bonds have a pretty attractive risk-return profile. And what I mean is that, if you're sitting in an average bond today and you're collecting, let's say, a 4.5% coupon, right? If yields don't move for the rest of the year, well, what are you going to do as a bondholder? You're going to collect your 4.5% coupon, say thank you very much, and be done. Not bad. If yields go up, now everyone knows that when interest rates go up, that's bad for bonds, right? Because interest rates go up, bond prices go down. And why is that? Well, if I own a 4.5% coupon bond and interest rates go up to 5.5%, Well, no one's really excited about buying my 4.5% bond right now because they can buy a 5.5% bond. So that means I have to lower the price of my bonds in order for someone to want to buy that bond from me, right? So, but the point of this is that even if rates do go up by 1% this year, which by the way, I don't think they're going to do. As a matter of fact, if anything, the Fed is most likely going to cut rates this year, right? And I'm not sure when they're going to cut, how much they're going to cut. A lot of people spend a lot of time debating that. I don't really think that's the point. The point is they will cut. So eventually, and the fact that they're going to cut probably means interest rates are going to come down. But if, for example, they don't and interest rates go up, well, you're still actually barely going to lose any money on your bond, right? Because you're still going to get that 4.5% coupon, and then the price will drop. If interest rates actually go up by a full percentage point, prices will probably drop in that bond by about 6%. So you'll have a slight negative return on your bond. I don't really see that as a likely scenario. However, a much more likely scenario, in my opinion, is that actually rates drop. And if rates drop by 1%, well, what happens to bond prices? They go up. And so if bond prices go up, in addition to clipping that coupon for 4.5%, if I also get a 6% return on my bond, well, now I'm looking at double-digit returns on bonds, which is pretty nice considering bonds are pretty low risk compared to stocks. So I really like that asymmetrical risk return scenario that really favors bondholders. So that's one of the reasons why, and we'll talk about that more, we are comfortable shifting more of our clients' assets into bonds because we think it's a pretty good place to be given these dynamics that could play out with interest rates. So what do I think is important to look at this quarter? What are we paying attention to? Everyone talks about avoiding a recession. And if we avoid, quote unquote, any shocks this year, well, we probably avoid a recession. The problem is, well, what is a shock? What may happen? Well, there's a lot of things that can happen. This is why recessions happen. People don't anticipate certain shocks that come out of nowhere, right? There could be a geopolitical event. We could have really crazy election dynamics late in the year. There's a lot of interesting shocks that could derail things. But so far, so good on the consumer. I mentioned how we're a little worried about that moving forward, but so far the consumer has been pretty strong. Wage gains have been outpacing inflation, meaning that consumers can afford to buy things even though prices are high. But again, we talked about how those wage gains have been slowing, and they're probably going to keep on slowing. And, corporate spending has been pretty good, especially because corporations are investing a lot in this new artificial intelligence technology, which is going to make them more efficient and more profitable, right? But as I mentioned, the Federal Reserve interest rates now are in restrictive territory. What does that mean? It means that short-term interest rates are high enough that it's putting brakes on the economy. It's causing the economy to slow down. When interest rates are high, businesses tend to invest less because it costs them more money to borrow. So building that new plant or investing in that new equipment, if you have to borrow to do it, is less attractive when interest rates are high, right? And so that dynamic is still playing out, right? And we do think that the Federal Reserve, there's a lot of reasons to believe that they have been successful in getting rid of inflation, but you never know. Inflation might surprise on the upside. And if it does, maybe the Fed doesn't cut as much as many people think. So that's something to pay attention to. But as I mentioned, right, now that the Fed does have interest rates at a high level, everyone talks about how the Fed put option is back. The put option is if things go badly in the economy, the Fed has the ability to cut rates. 2 years ago, the Fed couldn't cut rates because rates were at zero. But now they can, right? Because rates are over 5%. So not only, as we mentioned, is there a lot of cash on the sidelines that will ideally pour in if the market takes a drop, but if the economy goes, has a lot of trouble, well, then the Fed can also start cutting rates and cut rates quickly if they have to mitigate any difficulties that we see out there. So I think that's pretty good for those of us who might be nervous about the market being pretty expensive, which, to be fair, it is. There's reasons to think that there are mitigating factors to any drop that we see. So I'm not that worried, right? And that's Alfred E. Newman from Mad Magazine. Maybe that's before some of your time out there, but I remember that magazine pretty prominently being in the magazine racks of the local newsstands that I used to walk by. And the other thing I want to mention is that we are really in the early stages, I believe, in what artificial intelligence can do for companies and profits. Some people associate the artificial intelligence movement to what happened when the personal computer was first introduced in the 80s. I don't think actually that's too much of a stretch to think that artificial intelligence will have a big impact on companies' ability to be more efficient, on employees' ability to be more efficient. I think we're really going to see that start to play out over the next several years. So, and that's also good for profits. And as we talked about, company earnings have been surprising on the upside. Maybe with a lot of artificial intelligence investment and good results, we'll see earnings continue to surprise on the upside. So that's one of the reasons why, yes, the market's high, but perhaps it's high for a reason. Perhaps the market's price to earnings ratio, because earnings will come in better than we think, and that ratio will actually come down without prices coming down if earnings keep surprising to the upside. So what does all this mean for what we're doing? Well, given the fact that there's kind of this push and pull, like, should we be nervous that stocks are expensive? Should we be optimistic because earnings are coming in that are really strong? We're neutral on stocks. We're neutral on equity. We're a little more excited about U.S. stocks than international stocks. And part of the reason is because our economic numbers have been better than pretty much anywhere else in the world. So we do want to favor U.S. a bit over international. And that's always despite the fact that international stocks are much cheaper than their U.S. counterparts. But because the economic numbers here in the U.S. seem to be a lot better than abroad, we do think it makes sense to tilt towards the U.S. We also think that we should favor more what I'll call quality large cap companies. And the reason is because if there is a recession that might be looming out there, that might sneak up on us when we least expect it, it's the companies that are the biggest with the strongest cash flows that tend to do the best during a recession because they're not in any danger of going out of business. It's the small cap stocks that can suffer the most during a recession because in general, if a recession happens, some small cap companies won't survive. So that's why we want to basically favor more large cap versus the smaller cap counterparts, because we do think we're in that part of the economic cycle where if we hit a slowdown, that's where small caps tend to get hurt. The other thing is there's new research that we've been taking a look at out there that talks about, if you look at a traditional investment textbook, it'll always say that one of the reasons you invest in small caps is because they have the highest return potential. They have the highest return potential over the long term. And that's true because small caps are the riskiest. So if you invest in something that's risky or the most risky, you should ideally get paid the most because you took the most risk. However, there's reason to believe that that classic dynamic is changing a bit. And that's because a lot of companies today are not going public early. A lot of companies are choosing to wait to go public until they're already quite large. And because of that, the growth that sometimes we used to see when companies went public when they were small, and then you could ride them all the way up until they got big, those are harder to find today because companies are staying private for longer. So that's a dynamic that might be crimping the argument for having a healthy allocation of small caps. So that's something we're taking a look at. And we also, in the equity sectors that we like, we do want to favor a bit on tech. And as we were talking about, if there's one sector that's probably going to benefit the most from AI, it's definitely going to be tech, right? Don't get me wrong, other sectors will benefit as well, communication services, industrial stocks, but tech will benefit most likely the most, assuming that we are in the early stages of this AI revolution. So when we do look at portfolios, we will be balancing them a little bit more towards the technology sector relative to a lot of other sectors. And then, of course, last but not least, we can't forget about fixed income or bonds, which is, we like bonds. We are actually going to be moving more into bonds. We're actually going to start favoring a little longer maturity bonds and a little more corporate type bonds that have, the exposure to credit, as opposed to just treasury bonds, which we've been staying pretty short term on the treasuries, and there's no credit risk with treasuries because it's the US government. But we think it makes sense to actually go out a little bit on the yield curve, take advantage of, the fact that eventually those short rates are going to come back down. And when they do, we want to make sure that we've already taken advantage of sort of that middle part or the belly of the curve. So we are adjusting our fixed income exposure because we also, again, we think that if interest rates overall are coming down, bonds are a good place to be no matter where you are on the yield curve. So with that, that was a solid 30 minutes, I believe. We can open it up for questions. I know we have some questions that are asked in advance, and I'm going to address those, but I didn't know if any came in while I was yapping away.
Hey, Steve. Thank you. As always, it was extremely helpful. I don't think any questions have come in yet. If you guys have questions, feel free to pop them into the QA box at the bottom of your screen, and Steve will answer those. In the meantime, there were a few that came in beforehand, one of which was, can you tell us about the inheritance laws that are changing?
Yeah, I think that's a great question. And I saw that come in, so thanks for that question. So what a big thing is going to happen at the end of 2025. So at the end of not this year, but next year, is that the Tax Cuts and Jobs Act, is going to that came out of the Trump era administration. They're going to expire. And so right now, if you're a pretty well-to-do family, you can actually pass an estate to your heirs of up to $26+ million without paying any estate taxes on that estate. And that was part of that tax cut bill that went through. So the bottom line is, that's a good problem to have, right? If you're passing on that much money. But the bottom line is a lot of estates are therefore safe, and they don't need to worry about getting hit by punitive estate taxes, which can run up to 50%, including state levels. But that is going to change in a couple of years, and I'm very confident that it will not stay at that level. And as a matter of fact, if nothing happens, it's going to be cut in half. But there will probably be movement to change that legislation. And it wasn't too long ago that the estate tax exemption was really only a couple $1 million. Which meant that if you had a nice house that was worth $2 million and then some nice accounts that you were passing on to your heirs, you were getting hit with estate taxes. So the bottom line is there are lots of things that people can do now to lock in that massive estate tax exemption that still exists today. And that requires estate planning. It usually requires the establishment of trusts. And there are other creative things you can also do to start to transfer assets to others or other next generations. You can do annual cash gifting. You can contribute $17,000+ a year per person without paying taxes on it. You can accelerate 529 plan gifts. There's a lot, and you can do a Roth IRA conversion from a regular IRA. And if you believe that I do, that ultimately down the road taxes will be higher than they are today, which I think based upon the deficits that our government is running, that's probably an inevitability. It might make sense to think about doing that conversion, that Roth conversion. Even though you might pay a lot of taxes today, you'll probably end up being happy about it 10 years from now. So, but of course, this all depends on your personal situation. And that's why we'd be more than happy to talk to anyone who'd like to get into the details on this, where we can do an analysis and figure out, hey, what makes sense for you to do to avoid estate taxes, to think about these things, and what can you do today? What might you want to do next year, et cetera. So great question. Lots of detail there. And again, it'll depend on your personal circumstances, but that's what we're here for, to talk about.
Perfect. Okay, another one that came in is, can you give us some tax tips for investing in real estate?
Right. So I should have our CPA partners on this call with me, because everyone's asking about taxes, and maybe that's because everyone's getting all their tax statements now, right? It's February, so it's time to pay the piper. But one thing about real estate that I think is there's an old rule or an old saw that goes, once invested in real estate, always invested in real estate. And the reason people say that is because if, for example, you have a real estate investment property, maybe it's a rental property or what, you can ultimately collect rent on that property, and because you depreciate the value of that property, you actually end up really not paying any taxes on that rent you collect, because you're basically offsetting the rent you collect with the depreciation value of the property, right? But what happens if you ultimately sell that property? Let's say 25 years from now, you've been collecting rent for 25 years, you really haven't paid taxes on it, but then it's time to sell the property. Well, the fact remains, you probably will have depreciated that property's value down to zero. So if you, let's say, bought the property for $500,000, and then 25 years from now, it's worth $2 million, but in the IRS's eyes, it's actually, you've depreciated to zero. So if you sell it for $2 million, you're looking at a $2 million capital gain, and you're going to have to pay taxes on that, which can be massive, right? And in the New York City area, where kind of my home base is, we see a lot of that situation, right? People who made the wise decision to invest in real estate many, many years ago, and then they're saying, I'm really tired of being a landlord and I want to sell, and then they're looking at a tax bill in the hundreds of thousands of dollars. So, but there are things you can do. You can, as long as if you do sell an investment property and you put it into another one, right? You do not, as long as you roll the full amount into a new property, you do not have to pay gains on that old property. Hence the term once in real estate, always in real estate, because you can just roll it into a new property. And perhaps if you're, getting up there in years, and that new property, you pass that on to your heirs, well, that new property will pass on to them, and you won't end up paying taxes on it. So the bottom line is, there's other ways to also, let's say you don't want to be a landlord anymore. There are investment vehicles that are known as Delaware Statutory Trusts, or DSTs, where you can actually invest in a very nice diversified pool of real estate that's managed by a professional real estate company, where you just collect rent and you don't do anything. You don't chase down tenants, you don't mow the lawn, you don't really have to worry, right? And so there are options for people who are thinking about, hey, I've got a big potential gain. If I want to get out of this real estate investment, what should I do? We certainly have some things to talk about that can be beneficial from a tax perspective, assuming that, the objective is to minimize the tax burden if you were to exit this particular real estate investment. So that's just one angle. I'm sure there's lots of other angles that we can discuss, but again, it all depends on individual circumstances. So once again, that's why we encourage people, let's talk about it. Let's discuss it.
Perfect. That makes a lot of sense. Well, I don't see that we have any other questions. So thanks for going through those. We do, however, have a couple of quick announcements for everybody on the call. One is we have a really great session coming up on March 28th. Its focus is going to be on retirement and common mistakes that people make and how to avoid them. So you can sign up on the Nisivoccia website or on the Wealthspring website, and we will also be sending emails soon. But again, that's March 28th. It'll be a really great session. We hope to see more of you there. And then there's also going to be a survey at the end of this session. It takes about 90 seconds to fill out. And we use that feedback to improve these sessions, as well as plan our calendar and find out what topics that you're really interested in. So with that, I'm going to hand it back to you, Steve.
Thank you very much, Alana, and thank you all for listening today. Hopefully it was informative. And until next time.
Thanks, guys. Bye-bye.